Welcome to the FI View with me, Tanveer Gill. The show is back to highlight what global money managers and market speakers are making of India and other emerging markets within the global market setup. Joining me on the show today, my first guest is David Lubin, who's Managing Director and Head of Emerging Market Economics at Citi. He joins me from London. David will be throwing more perspective on India post the vote on account speech by the Finance Minister and giving us a sense of how the view on emerging market economies is shaping up as against the developed world. David, thanks very much for taking out the time and speaking with us. Let me begin by asking you your India outlook going forward post the interim budget speech with the current account deficit expected to come in at below $40 billion. That's close to about 2% of GDP versus a figure of 4.8% of GDP last year. The Finance Minister had clearly stated that India has averted a ratings downgrade. That's the key issue that everybody's been talking about. Do you agree with that view? Do you think India has averted a ratings downgrade with the improvement in the macro risks?
For the time being, yes, that's possibly true. But I think in general terms, if you go back over the last 10 years, there have been two fundamental pillars on which emerging economies have built their improvement in creditworthiness. One was stable and improving debt-GDP ratios, and the other was the accumulation of foreign exchange reserves. I mean, in India's case, we've seen reserves go from around $50 billion to $290 billion over the last 10 years. Even if debt-GDP ratios can be stabilized through disciplined fiscal policy, there is, I think, still going to be some pressure on reserves accumulation. In other words, I don't think the next 10 years will see, or the next few years, will see such favorable environment for reserves accumulation in emerging economies as we've seen in the last 10 years. The environment for capital flows is more hostile. The external demand environment supporting export growth is more hostile. And so I think, in general, emerging markets' creditworthiness will, at the margin, come under some downward pressure over the next few years. That's not to say anything specific with India in the short run, but I think it will become more difficult for emerging economies in general to sustain the improvement in creditworthiness that they've enjoyed in the last 10 years.
But on that point, on both those variables, debt to GDP and forex reserves, do you believe India has fared better than other emerging markets?
Yes, absolutely. I mean, what India demonstrated over the course of the second half of calendar 2013, more than anything else, was quite a dramatic adjustment in the current account deficit. And since the current account deficit is so central in the way the market assesses vulnerability across emerging economies, the squeeze in the current account deficit is phenomenal. Now, of course, a lot of that deficit reduction in India's case was achieved through compression of gold imports. But the good news is that India, of the fragile five economies, India, Indonesia, Brazil, South Africa, Turkey, India was unique in its ability to demonstrate an acceleration of export growth. And the dynamism of Indian exports is, I think, a kind of very important very important source of confidence for India right now. And I think that, if that's going to be sustained, that'll be very good news indeed. Partly because it'll be difficult, I suppose, to keep the squeeze on gold imports for a very long time.
Right. You foresee 5.5% growth for FY15, David. The Finance Minister has indicated 6% plus growth. How much of this will be export-led given the currency fall, and how much will be revival in domestic growth? Also, what would be the key drivers for this growth?
Well, I think although Indian export growth has been very decisive and very apparent and helped to shrink the current account deficit, India remains a relatively closed economy, and so strong export growth is not necessarily going to deliver fantastic news for GDP growth overall. And I think there's still, although Indian export growth has accelerated in the last few months, until December at least, there's still a serious question mark about the robustness of the external demand environment that emerging economies face. Growth in the Eurozone is weak, growth in the US is okay, but it seems that US growth is not particularly friendly, at the moment at least, towards emerging economies, in the sense that the growth that we're seeing in the US is not producing a huge increase in import demand. And so there's still a number of questions around the external environment. And I think in general, the sources of growth in emerging economies will have to become more homegrown over the next few years. And what that means in turn is that growth is going to rely much more heavily on a kind of decisive implementation of structural reforms. And of course, on that question, we have to wait and see until the outcome of the election and what kind of government is formed in India and whether it's able to deliver that kind of structural reform agenda.
What do you expect in terms of policy action from the RBI as central banks across emerging markets have hiked rates to protect their currency and ease inflation despite growth being a key risk?
Yeah. I think central bank credibility has two components to it. One is a central bank's credibility with respect to the inflation target, and another is a central bank's credibility with respect to the balance of payments. In other words, is monetary policy gauged correctly to deliver a financeable current account deficit given what we know about the state of global capital flows? And if you go back to January and look at the rate hikes that were delivered by the Indian Reserve Bank, the Central Bank of Turkey, and the South African Reserve Bank, I think you see different themes. In the case of India, I think, as we've discussed, the Reserve Bank of India is broadly credible with respect to the balance of payments, given the reduction in the current account deficit. But the Reserve Bank of India is not that credible with respect to inflation, particularly given in the context of the Patel Committee recommendations. By contrast, I would say that the South African Reserve Bank is broadly credible with respect to the inflation target, but is not credible with respect to the balance of payments, because in South Africa there's been hardly any current account adjustment. And I would argue that the Central Bank of Turkey is credible with respect to neither the inflation target nor the balance of payments, which is partly why Turkish Central Bank in January had to do so much more in terms of rate hikes than either the RBI or the SARB. And so I think you have to kind of be careful about how you divide up the analysis of central bank credibility. And I think at the moment, inflation-fighting credibility is much more an issue for the RBI than sort of balance of payments credibility.
So specifically about India, what do you expect from the RBI next?
Well, it partly depends on how much additional pressure is out there from the foreign exchange market. I mean, if we do see more pressure coming onto the rupee, then I think the central bank will want to be seen to deliver a decisive response and want to be seen to be credible with respect to the CPI, now becoming a more dominant feature in the central bank's monetary framework. And although it's easy to argue that the rupee depreciated last year by a significant amount and is also quite depreciated in comparison with its 10-year average, for example, it's difficult to say definitively that the pressure on the rupee is over. We still face a very uncertain environment in terms of the outlook for global capital flows. And one of the things that I think leaves India vulnerable, as well as a number of other countries, Turkey, Brazil, and some others, is the increase in foreign indebtedness of the corporate sector. If you go back to 2008, the FX-denominated indebtedness of Indian corporates was around $115 billion, and now it's above $200 billion. So there's been a large increase in foreign borrowing. And that's in response to very low interest rates available in offshore markets. And as we see US rates continue to pick up, and particularly as we see the front end of the US yield curve start to pick up over the next year or two, I think that could become an additional risk for financial and balance of payment stability in a number of emerging economies, including India's.
Just stepping back a bit, David, India seems to have a lot of local macro issues and concerns of effective policy making, something that rating agencies have spoken about at length. But when you, like I said, step back and look out across the region, do you think India stands out as a relatively better market to invest in?
Yeah, I think so. I think over the, if you go back to the period since May, June last year, when the whole process of repricing emerging markets was kind of kicked off, dual shock that these countries are facing, i.e. the interest rate shock coming from the US, and at the time at least, and more recently as well, a kind of China shock in the sense that the market goes through these cycles of panic and despair about the risk of an abrupt slowdown in China. During that period, the market has begun to kind of differentiate across countries, and I think that differentiation has taken place along three principles. The first is how visible is the evidence of current account adjustment, And of course, on that point, India scores very well, as we've discussed. The second is how credible is the monetary policy environment? And again, I think particularly with the arrival of Dr. Rajan at the RBI, central bank credibility has been enhanced, and so India scores well on that front. And the third is about the whole prospect for structural reforms. And one of the things that I think has helped support India in financial markets in the last few months is that when you compare the outlook for India's structural reform process with, for example, Turkey or South Africa or Brazil, in those three countries, when investors think about the outcome of forthcoming elections, well, there's more ANC coming in South Africa, there's more AKP coming in Turkey, there's more Dilma Rousseff coming in Brazil. There isn't any hook for markets to kind of generate some sense of optimism about the future of the reform environment. But at least for the time being, there is a kind of hook in the possibility that the Indian election could deliver a kind of decisive change in the outlook for economic reform. Of course, we wait and see what the election outcome will bring and whether that will actually change the policy environment. But I think there has been a sense that there's at least a story in India in the way that there may not be a story in some of the other fragile economies.
Okay, let me get in your emerging market outlook as well. In August last year, you believed that emerging market growth was getting weaker. Are you convinced we are at the bottom of this weakness now, or is there more to the slowdown still?
Yes, I mean, if you go back to May and June, those fragile economies that I mentioned, the fragile five, India, Brazil, Turkey, South Africa, and Indonesia, were considered to be just one block of countries. And what we've seen over the last few months is that block has disintegrated, and there's much more fragmentation in the way investors perceive these economies. And I think that fragmentation has kind of been developed along the lines that I suggested. And that it's almost as though the market is applying three tests to each of these countries, the current account adjustment, policy credibility, and the outlook for structural reform. And I suspect that will remain the case. But as I say, we remain in an environment of tremendous uncertainty around three issues in particular. One is the outlook for capital flows to emerging economies. Although there are kind of structural factors that support a positive outlook for capital flows to emerging economies, there's also a nasty cyclical headwind in the form of less loose monetary policy in the United States. The second issue has to do with the outlook for China. The Chinese policymakers are managing quite a delicate balancing act between, on the one hand, wanting to implement reforms in the economy outlined last November at the third plenum, and on the other hand, wanting to stabilize GDP growth. And that balancing act is going to remain a source of uncertainty for investors, I think. And the final uncertainty that we're all having to kind of live with at the moment is what the outlook is for import demand in the developed world. I think one of the most important ways of understanding the slowdown in emerging economies over the last couple of years, and indeed one of the most important ways of understanding the emergence of current account deficits in these countries, is that emerging economies have been subject to a nasty external shock in the form of declining import demand or declining import growth in the developed world. From August 2012 until August 2013, the growth rate of import volumes in the developed world was negative. It was as though there was a kind of import recession in the developed economies, and that constituted a very nasty shock for emerging economies. And a critical question is, first of all, what is the quality of the recovery going to be in the developed world? And we see, different types of evidence of that. Disappointing numbers from Japan this week, and the consequences of very bad weather in the United States for the US data. And secondly, even if there is a kind of reliable and robust recovery in the developed world, whether that recovery necessarily creates a robust demand for imports from the developing world. And it's possible to argue that there might be a kind of structural change in the nature of growth in the developed world, which may produce an environment where growth in the developed world may not be so friendly towards emerging markets.
Let me just talk about those points that you made individually. First up, on the tapering issue. Now, many correlate the whole tapering effect to liquidity withdrawal from emerging markets. As I was reading some of the reports, most of the QE, or the stimulus, nearly 90% of it has actually moved into bank balance sheets in the US rather than finding its way to emerging markets. Does that mean that the emerging market underperformance is one due to lack of interest on account of the growth slowdown that we're seeing right now, than really an issue of lack of money?
Well, it's an interesting question. For most of 2013, the kind of dominant way of understanding emerging markets is, as I said before, that emerging economies were being hit by this nasty US interest rate shock as the US 10-year Treasury yield went from 1.5% in April last year to 3% towards the end of 2013. What was interesting at the beginning of 2014 was that renewed pressure on emerging market currencies developed even while the US 10-year yield was falling from 3% at the beginning of the year to 2.7% at the end of January. So that seems a bit odd. You know, if the main source of pressure on emerging economies was rising US interest rates, why should this pressure become visible when US interest rates are falling, long-term US interest rates are falling? And I think the answer to that, in order to answer that, go back to May and June last year. In May and June last year, the idea was that emerging economies were confronted by two shocks. One was the US interest rate shock, and the other was China risk. What happened in the second half of last year is that China risk diminished. The 5-year spread for China CDS, sovereign CDS, went from 140 basis points in June to 65 basis points in mid-December. In other words, that way of measuring China risk made it look like China risk was disappearing. But at the beginning of January, we had two things. We had one, a greater awareness that China risk was back on the table because people were nervous about the data in China. And two, the fact that US Treasury yields were falling in January had its counterpart in weak US data and the idea that maybe the US recovery, whether it's weather-related or for some other reason, may not be so robust. And when you combine those two factors, greater uncertainty about the strength of Chinese data and greater uncertainty about the strength of US data, the picture that's painted is one of a very or not very supportive external demand environment. So in a way, emerging markets are kind of damned if they do, damned if they don't. They suffer when US interest rates rise because that takes liquidity out of the system. And they suffer when US interest rates fall because that indicates weaker external demand. And it's true, emerging economies depend on both of these things. Emerging economies depend on plentiful global liquidity because that supports capital flows. And they also depend on robust external demand because that supports growth in the current account.
You also spoke about import demand growth in the developed world. You mentioned recently that there is still a hostile environment for exports. How do you view global trade? Because a large part of the growth revival story in emerging markets is predicated on export growth. Where will that growth come from if the US and Europe import demand doesn't pick up? Do you think that the whole export growth story for emerging markets is really questionable right now?
It's a tough question, and I'm afraid I have not very much that's really concrete to say about it. I think there are just a number of puzzles. I mean, one puzzle is Indian export growth. Why did Indian export growth accelerate in 2013? It's difficult to answer that question because if you look, for example, at Turkey, which is also has an export sector that's dominated by manufacturing goods like India's. Turkey also saw its real exchange rate depreciate quite substantially in 2013, and yet Turkey didn't enjoy the same kind of acceleration in export growth that India did. I suspect that in Turkey's case, the problem is that the performance of Turkish exports is more sensitive to external demand conditions than it is to price. And so as long as Turkey's main trading partners, particularly in the Eurozone, remain very weak, and the import demand picture remains constrained for Turkish exporters, that's a more important headwind than the sort of tailwind that's created by having a relatively depreciated exchange rate. And that, in a way, is a problem for a lot of emerging economies, not just economies with manufactured exports like Turkey or India, but also, and maybe in particular, for economies like South Africa, Brazil, Indonesia, who have export sectors more dominated by commodities. We're still in a state of, I think, high uncertainty about what the external demand picture is going to be for emerging markets exports. And in a way that helps, that sort of is one of the reasons why I think the sources, the more reliable sources for GDP growth in EM over the next few quarters and perhaps the next few years are more likely to come from domestic spending rather than from net exports.
Sure, but what's your specific view to the risk there is to emerging market currencies, especially a currency like the Indian rupee? Has the risk of a further fall receded?
I think it's a tough question to answer. One of the reasons is that when you make a judgment, that when the market makes a judgment that a currency is undervalued, the market is kind of presupposing that it knows what the equilibrium exchange rate is. You say a currency is undervalued with respect to its equilibrium. And one of the problems that we've all got these days is that our concept of an equilibrium exchange rate is in flux. To give you an example, if you go back to the middle of last year, I think every exchange rate model would have told you that the Brazilian real was overvalued. But equally, every exchange rate model probably would have told you that the Indian rupee was undervalued. And yet both of these currencies suffered big shocks. And I think that kind of is a way of explaining how our concept of an equilibrium exchange rate is just all over the place. And really the reason for that is that we don't have a good handle on what the growth model is for emerging economies, and we're moving into uncertain territory.
And where does that leave your growth outlook for emerging markets then? There seems to be a delay, time-wise, so to speak, for the revival in growth momentum in these markets. As you've been seeing a delay even in the US, when do you expect growth to pick up?
Yeah, well, I'm not sure we share that. We're not tremendously optimistic about the outlook for emerging markets growth, precisely for the reasons I was trying to outline earlier. I think we remain in a very uncertain world, not just with respect to the outlook for developed country growth, but also in terms of the linkages between developed country growth and the performance of emerging markets exports. And
suffice to say that as far as pickup in growth for India is concerned, you're cautiously optimistic, given your expectation of 5.5% growth for FY15?
Yeah, I think that's a fair assessment.
All right, David, we leave it at that. Thanks very much for taking out the time and speaking with us. We appreciate your views today. With that, we come to the end of this edition of the FI View. Catch you with another special guest next week. Till then, thanks for watching.